Hello, and welcome to the Making Hay podcast with your host, Marcia Miller. Marcia, good to be with you again. How are you?
Hey, Bill. I'm wonderful. How are you? Always a pleasure.
No. The pleasure is entirely mine every time, all the time. So, what are we talking about today?
Yeah, we're going to be talking about long-term care insurance and all the latest and greatest around that topic.
A topic that I avoided for a very, very long time. Probably too long, so maybe it's good you start talking about it now.
That's a very good point. Everyone avoids it because if we avoid it, it's not going to happen to us.
Exactly.
That's what we think. It's foolish to think that, but that is, I think, a lot of how people think. So we're going to talk about it today. And we've got a wonderful guest today. So welcome Alicia Barnett to the show. Alicia has a certification in long-term care. She specializes in education and advising today's leading financial professionals in holistic care planning. I've known Alicia for about 20 years, and I know she knows more about long-term care and planning than any other person I know. So welcome to the show.
Thank you so much, Marcia. I am so excited to be here. And you know, this is a subject matter that I am really passionate about. So I appreciate you having me today.
Absolutely. You know, it never ceases to amaze me that in my 25 plus years in the industry, you know, people will spend all the time in the world to make sure they're funding their 401k, you know, setting up other investment accounts, making sure they're buying the right stocks and the right bonds, and, you know, to do all of that their whole life to only fail in the end by not doing long-term care planning. So I think this is probably due to a lot of misconceptions. And hopefully today, with your help, you're going to help us clear that up. So what are some of the common misconceptions or myths that come into play with long-term care thoughts and planning?
Absolutely. Well, you kind of hit the hammer on the nail a second ago. Most people don't think it's going to happen to them, when in reality, there is a 70% chance that if you're over the age of 65, you'll need some type of care. And in fact, you know, 1 in 5 need 5 or more years of care. So there's a much greater chance that you will need care. And that is definitely one of the biggest misconceptions. The second biggest misconception is my family will take care of me. And Marcia, we know how that goes. Long-term care doesn't bring families together. It tears families apart. Oftentimes it's the oldest daughter in closest proximity who does most of the caregiving. You know, if that's the case, maybe she'll quit her job and move in with you, or maybe you'll move in with her. Your life really doesn't end, someone else's does. And that really causes a lot of problems. I have a plan so that my twin boys will talk to each other when I die. So big misconception. Yes, your family will step in and take care of you, but do you really want them to?
Exactly. Well, my dad's 93 and he's in a long-term care facility now. He's in assisted living, so he's sharp as a tack. You know, obviously he's got some health issues. He can't live alone, but we're very fortunate to have him. But, you know, I can speak from that and identify with that on a personal level. I live away from my father. And so both of my brothers have the primary responsibility, and I feel guilty about it all the time, you know, and, but being, I guess in my profession, I'm relentless. I tell my brothers all the time, like, I love you and nothing's stopping that, you know? And so, you know, it's just because I've seen the ugly things that can happen and tear families apart. I've seen families that are split for generations. You know, the cousins aren't going to speak to each other, let alone
It is so true.
let alone the siblings. So I think that's so important to talk about before you need it.
Absolutely. And I think I would be remiss if I didn't mention another big myth, which is the government will take care of me. And whenever I do a podcast or a live event, I always get a big chuckle when I ask, well, how many people think the government is really going to take care of you? And while it's funny, it's not really funny because there's a lot of misconceptions that go along with that. For example, Medicare, it's really short-term care, not long-term care. You have to be hospitalized at least 3 days. You have to be getting better or rehabilitating. And it typically only covers up to 100 days of skilled care. And you and I both know about Medicaid. You have to spend down your hard-earned assets.
Right.
And if you're married, you could leave your spouse impoverished. And typically it only covers care in a nursing home. And I don't know about you, but Marcia, I really would rather receive my care in the home.
Absolutely. Well, what are the types of long-term care that are out there?
Well, gosh, Marcia, there are so many, but there are really two main types that mitigate the risk, in my opinion, for long-term care planning. And that's traditional long-term care and asset-based long-term care. And I like to use the analogy owning your policy versus renting. So traditional is like renting. For example, paying into homeowners. If you need it, you've got coverage. If you don't, there's no death benefit. There's no equity in that policy. You don't get any money back when you cancel your homeowner's policy. So traditional long-term care is really the cheapest way. You buy the most amount of long-term care. However, rates can go up. If you don't use it, you lose it, and there's certainly no exit strategy. Whereas these newer types policies called asset-based long-term care is like owning your policy. You have a benefit whether you live, whether you quit, or whether you die.
Yeah. And I love that. I'm familiar with that and have some of those in place for some of my clients. I mean, it's on your balance sheet.
That's right.
It's money that's there, that's on your balance sheet. You can see it. And if you don't use it, which is our prayer that we don't ever need it, when my mom was passing and ill, my brother came over one day and said, there's nothing wrong with not waking up one day.
That's right.
I'm like, if we could just all time it, and unfortunately that's not an option, being obviously, sarcastic, but definitely I like the fact that that's an option, that it can be on your balance sheet. So, again, I've been an advisor for a long time. I actually had a client in on Monday of this week. She has a traditional long-term care policy that she's actually 83, and her and her husband bought the traditional long-term care in their 50s. And it was before I knew them or had him as a client. And it's one of the major players out there. And I've seen this over and over again. I want to have your opinion on this. So the letter said, the reason I mention it is I think a lot of our listeners, maybe their parents have long-term care, traditional long-term care, or maybe they've experienced this themselves. But her letter said, well, I think because she's 83, we're not going to increase your premium right now, but I have seen other clients who've gotten similar letters, and it says, hey, we're going to increase your premium, decrease your benefits. In her case, they were offering her a lump sum payout of like $30,000 at age 83. So like, why is that a problem? Is that continuing, or is that just those older policies that were purchased 30 years ago?
Well, that's a really good question. And Marcia, I would say it's for the older policies, and it's kind of given the long-term care industry a bad name. Unfortunately, when these products were developed, interest rates were really high, and persistency rates, meaning did you keep your policy? And most people were keeping their policies. Less than 3% were letting those lapse. And the two combined was just a whirlwind of problems for the insurance carriers. So in order to keep the promises that they made, they're having to, because they priced these products too low, they're having to give all of these rate increases. So I've seen them anywhere from 15% all the way to 250%. It's a shame, but they're still less expensive than having to pay that out of pocket or having to go back and replace those policies. So Number one, I would encourage you to keep those policies if you can. And if you can afford them, I wouldn't even reduce the benefits. Mm-hmm. So, that's something you can always run by Marcia. If you do have an existing policy, we can take a look at it, but that's 9 out of 10 times my advice. Now, as far as future policies, I think the traditional long-term care policies are priced better. Now, I don't have a crystal ball and there are no guarantees. That's the unfortunate part. But as far as what I'm saying, I don't think we're going to see 250% rate increases in the future on those. But there are those alternate products, which are the asset-based long-term care policies, and they cannot raise rates on those. So again, that's why I use that analogy, owning your policy versus renting it. And some people are willing to pay a little bit more for those guarantees.
Yeah, that is such a good analogy. I'm gonna remember that and use that, because that's exactly what it is, And again, it's okay to own it, because when you pass away, if you didn't use the benefit, someone is getting it. I would really love if my homeowners and other insurance would pay me back if I didn't use it. They don't do that. So
that's right.
I think that's a great analogy. Two, I think it's an aging population. I mean, every city I go to, I see senior living facilities being built. So I just think they didn't price that out. I mentioned that because I just don't want to scare people off from considering it, and talking to their advisor about, what about long-term care? And pretty much my opinion is you need to take either a portion of your assets if you think you have enough money, or abundance of money, because that is one of the objections I get when talking to people. Well, I think I have enough to self-insure. Love your opinion on that.
Oh my goodness, self-insuring. So can you really self-insure? You can't. You can self-fund, but here's what I tell everyone. If you don't have a plan, your money is your plan. And people don't really understand how expensive it is. I mean, on average, you're looking at $109,000 a year across the country, and that's going to vary place by place as to how expensive that is. And it's really, in my opinion, not about the finances, it's about the family. So that's really what it boils down to. But I mean, just think if you had to, if something would have happened tomorrow and you need home care or assisted living or nursing home, which asset would you liquidate first? And that's something to think about, as you go through the years and you're looking into retirement, because if you have to take income out to pay for long-term care services, that's going to in turn affect your principal, which is going to affect your overall portfolio. And again, people don't realize how expensive that is. And what kind of impact that can have on their portfolio. And I always recommend, hey, if you think you can afford some of that risk, let's at least cover 50% of the high-end average risk, which is nursing home. And that'll typically cover almost 100% of home care and assisted living. Because I don't know about you, but most people I know would rather receive care in the home. And if you can self-fund some of that risk, maybe that's where you can pick up the rest of that tab if you were to need nursing home care. Does that make sense?
It does. It does, definitely. I think that's very critical to understand. But I agree with you. The biggest reason to purchase it is for the family dynamics.
Exactly.
It's literally the biggest gift you can give your family is purchasing long-term care and talking about it. So what about tax advantages? Are there any tax advantages to purchasing long-term care? I know there used to be. Not sure where the law is on that now.
Absolutely. So depending on which way you want to look at this, as far as premiums versus benefits out, premiums, depending on how you fund the plans, because you can fund these solutions with any asset under the sun. For traditional long-term care, the LTC premiums can, and I'm not a CPA, but they can be tax deductible up to the age-based limits. And if the premium is above 7.5% of your adjusted gross income. So there's a little bit of tax deductibility there.
Okay.
If you're a business owner, for example, a C Corp, the LTC premiums can be tax deductible. On the asset-based side, those are typically written on a life insurance or annuity chassis. The LTC portion that comes out of those contracts to pay for the long-term care benefits, that can be a tax deductible expense as well. But the biggest tax benefit is using the long-term care benefits. Every dollar that comes out of these solutions comes out tax-free. I like to say it's tax efficient and pennies on the dollar leverage for long-term care. And everybody that has money, even those self-funders, understands that leverage. And that's really what this is about, tax efficiency and pennies on the dollar leverage.
That's such a good point, because if you're trying to sell, if you're self-insuring or think you have enough money to cover it, really there is no self-insurance. But if you think you're going to cover it with the assets because you have more than you're going to spend, there's tax ramifications there, or you can pull it out of your IRA, then that's a fully taxable event. Are you going to sell a piece of real estate, and can you even sell it at the right time?
That's right.
It's just definitely better to plan in advance and put that in as part of your holistic plan. So, yeah, for sure. When is the best time to buy? I mean, is there a certain age that's like, this is the golden time to buy, the golden window?
I love that question. You've never been younger and healthier than you are today. So the younger you are, the better. You hear some experts out there, or so-called experts out there, that say, oh, you should be in your 60s. 60s are great, but the younger you are, the healthier you are, the less expensive it is. So why not buy a policy, even if you can't afford a fully comprehensive plan? Start off smaller and layer. But again, it's going to be less expensive. You're not going to have the health issues, because as you age, you know what happens. Sometimes we become frail and begin having some health concerns. Right. So we try to get these solutions put in place as young as we can. Now, that's not to say if you're in your 60s, 70s, and even 80s with some of the solutions out there, you can't get coverage. But just know that there's underwriting, and the older you get, again, the more health ailments that you do have.
what does underwriting look like? We get scared to think, oh my gosh, I'm not going to qualify. Something's wrong. So speak to that a little bit.
So underwriting, it's not an apples to apples with each of the carriers out there or a one size fits all approach. We have everything from guaranteed issue solutions to full underwriting solutions. On the traditional long-term care side of the house, they tend to be more conservative. So you're typically going to see medical records. You're going to see parameds, phone history interviews, and they're going to really look at a bigger overall picture. Whereas some of the asset-based LTC products, the annuity chassis is going to be a lot more liberal, and the life insurance chassis is going to be more liberal than your traditional long-term care. And depending on the carrier out there, it's going to be either simplified underwriting, meaning you just have a phone history interview, so a little less threatening and not as as thorough. They're still underwriting, but you're not going to have to go through, months of underwriting, waiting on medical records and possibly doing parameds. So, and then again, the guaranteed issue component on some of the solutions out there is available as well. So there really is a solution for everyone, regardless of your health. And 10 carriers, Marcia, may look at one condition 10 different ways, for example, diabetes. So it's really, don't be afraid that you can't get coverage. Make sure that you talk to your financial professional because there is a solution out there for you.
Right. And that's why I love having you on my team, Alicia, because you know these carriers, okay, if this person has this situation, we're not going to use X, Y, and Z company because it's not going to work for them. And this one favors that. So, case design is one of your specialties. And I love that. We can talk through what this client needs, what they're looking for, how to satisfy it. So that is fantastic as well. Well, let's recap here. Let's just kind of go over the key points. I think what I heard you say was basically get this for your family more than anything, and 1 in 5 people, you may have to help me with the stats there. 1 in 5 are going to need long-term care.
So 70% of people
70%.
over the age of 65 will need care. 1 in 5 will need care for 5 or more years.
Wow. That's crazy. That really is. Yeah. So, get it for your family, talk to your financial advisor, see how it fits into the plan. By asking the question, it doesn't say I'm signing up for this, but just, I always tell people, let's analyze it. Let's analyze it and see if you like it. If you don't, we're never going to talk about it again. I'm going to check that box off that I discussed it with you. Because if your family comes looking at me, I want them to know that I did my job of protecting you and taking care of you and taking care of the kids and grandkids too. And this is a way to do it. So, I just encourage you to talk about it, get educated, see if it feels good. And if it doesn't, dismiss it, never think about it again. So final thoughts from you, Alicia. What advice can you give our listeners, knowing everything you know? What is the best piece of advice you could give someone?
Again, you've never been younger and healthier than you are today. It's time to talk about this now. Don't put off the conversation. And as Marcia said, this really is a love insurance. Again, I have a policy so that my kids can supervise the care, not provide the care, and so that they'll talk to each other when I pass away. And then last but not least, as you mentioned, maybe an insurance solution isn't for you, but you need to have a written solution, whether that a written plan of care. So my encouragement today is to go out there and have that conversation with your family. Who do you want to take care of you? Where do you want to receive your care? Those are important questions that they ask because there's nothing worse than having to plan when you actually need it, at that moment. It's like, your hair's on fire and you're trying to put it out. You're standing in a bucket of water and you can't put that fire out. So It's really important to have that conversation and make sure your family knows about it, whether it's an insurance solution, whether you're going to self-fund and, which assets you're going to be using. I think it's just important to have that written plan of care.
Awesome. Such great advice. Thank you for joining us today. I'm so excited. We will definitely put all your contact information in the show notes, how to get a hold of you, where to find you on social media, your website, that kind of thing. And I am so appreciative of you being here today, Alicia.
Thank you so much for having me. It was a joy as always.
Yes.
Well, I want to jump in here because I've got a question for a friend. What happens when your friend waits too long, Alicia? And a conversation about long-term care comes up, and the rates that are mentioned are just staggering. in all seriousness, what are the choices for people who finally decided maybe I should pay attention to this and realized, yeah, I have never been younger, but than I am right now, but I sure am older than I was a long time ago.
Certainly. Well, what I can tell you is you can use with these solutions, you can pay for them with any asset under the sun. So you can use cash or cash equivalent, meaning money sitting in the bank that you've set aside. You can use highly appreciated non-qualified annuities, qualified money like 401ks and IRAs. You can use income. And then if it's not affordable, then unfortunately, sometimes there's that fine line between needing a long-term care solution and not needing it. I mean, Medicaid is a great program for those that need it. So financially, you can't afford it, then there are solutions as well that can help take care of you. It's just not going to be an insurance solution. But there are other vehicles out there that will also help. There's life insurance with chronic illness riders, annuities with income doublers. There are, my solutions that I talked about today aren't the only solutions out there. So just bring that conversation up to, your financial professional, and they'll be able to find a solution that will fit for you or your friend.
Great question, though, Bill.
Well, that's good, but it's because I think my friend has been leaning on the wisdom of the country songwriter Billy Joe Shaver, and I'm gonna live forever.
Why does that not surprise me,
Bill?
Nice meeting you as well.
Well, Marcia, this is great. I wouldn't expect anything less from you. From people who are listening to this conversation and thinking, I might want to have my conversation of my own with Marcia, how do they get a hold of you?
Yeah, absolutely. So a quick way to call me is 205-795-2013. That's our office number. Then also, if you want to schedule a meeting, you can go to meetwithmarcia.com. That's a quick way to find our website. Just remember, Marcia is Marcia.
Yep.
But love to talk with anyone about this.
That would be great. And I would encourage you, if you're on the fence out there listening to this, call her. I think you will really find the conversation worthwhile and even very helpful, as a matter of fact. The other thing you can do right now is, if you're not a subscriber to the podcast, reach out and hit subscribe. Hit follow. That's easy. Then every time Marcia drops a new episode of this podcast, you'll be notified and you can listen to it. I would also ask that if you like the podcast, tell people about it. Get the word out. Help people learn about what Marcia is talking about and connect them with Marcia. Word of mouth promotion is a really powerful tool, and we would very much appreciate it if you would do that. Until next time, I'm Bill Tucker on behalf of Marcia and everybody at Making Hay. I want to thank you for taking the time to listen today and remind you that today you can go out and make today a great day or not. It's your choice. Thanks so much for listening. Until next time.